Welcome to this Q3 Market Perspectives video. My name is Andrew Krei. I'm the Co-Chief Investment Officer here at Co-CIO Advisors. On behalf of my colleagues and myself, thanks for taking a little bit of time to watch this video. We're going to touch on three things. We're going to talk about the economy, and we're going to look at some of the mosaic of data points that we've been watching here as it relates to economic growth, the labor market, et cetera, and then ultimately how that impacts the Fed and their policy rate going forward. We're going to look at markets. We're going to look at some of the underpinnings of what we saw in terms of the strong performance within Q3, unpacking some of those key drivers. And then we're going to touch on gold, a word on gold at the end here, just because it has been such an extraordinary performer on a year-to-date basis. So with that, we'll jump in. So let's start by taking a look at the economy and some of the key data points that we've been watching. In particular, if we start on the top left chart here, looking at GDP growth, what we've seen is that yes, it's come off the boil, and that was anticipated as we moved into 2025. But some of the worst predictions, or the most dire predictions that we saw as related to Liberation Day and trade policy, et cetera, are not coming to fruition at this point. That the recessionary environment that several forecasters began to predict is not really materializing. And in fact, as we look into 2026 at this point, the consensus expectations are for a reacceleration of GDP growth at this point. So just from a broad, big picture backdrop, GDP looks reasonably healthy. And I think alongside that, we've heard a lot about the labor market. We've heard a lot about the consumer in the U.S. in particular. Will they or will they not be resilient against what we've seen is a more uncertain policy backdrop? And clearly, labor market has come off the boil, but we're not seeing numbers within retail sales, for instance, which we show on the top right chart here, or even jobless claims, which would speak to the level of unemployed people within the economy, really suggesting that there's any acute concern right now as it relates to consumer spending and household spending within the U.S. Now, all told, if we kind of roll that together and think about what that's meant for markets, we look at the bottom right corner here, which is the economic surprise index. And in particular, what we see here, this index is measuring where data actually comes in versus what was expected, for the consensus expectation. And these positive readings that we've been seeing now over the last several weeks show us that that has been quite good versus what people have been anticipating. And that ultimately flows into a repricing of stocks, a repricing of risk assets more broadly. Now, if you think about what all this means from the Fed's perspective, we can think about they cut rates, resumed their cutting cycle in September, and then we can look at what the market is anticipating alongside what the Fed has forecast themselves, but taking market forecasts through the balance of 25 and into 2026, and we can see that expectations are that the Fed funds rate gets down to about 3%, so about another 100 basis points of cuts. And that's really speaking to the idea that there's a consensus view, or there has been a consensus view at least, that the labor market was weakening and that growth was slowing. Well, perhaps if that's not playing itself out, and alongside that, if we look at the right side of this page, where inflation stays stubborn, stays elevated at about a 3% level, which is kind of where we're seeing it level off at this point relative to the Fed's 2% target, perhaps that calls into question the Fed's ability to actually cut that incremental 100 basis points going forward. You think about the implications there, certainly has a clear and sort of defined impact on yields and rates, which you would expect a little bit of a lift in that scenario if you're repricing Fed cut expectations. Then also can have some impacts on stock valuations. We'll talk more in a second about some of the most highly valued, richly valued segments of the market doing so well. Perhaps if they're not as much Fed cuts in the models going forward, if rates aren't going to be as low as people are expecting them to be, then we need to start thinking about valuations against a bit of a different Fed funds backdrop. Now, as it relates to markets in particular, what we can see here on the left side of this chart as we dive into what we saw in Q3 is that the Mag 7 resumed their leadership, right? They had done so well for the last 24 plus months, the mega cap tech cohort really driving returns for U.S. markets in particular. They went back to the top of the leaderboard essentially within Q3. Yes, international stocks continued to lead global markets on a year-to-date basis, as we see from the right side of this chart here, but technology names were the big winner within Q3. And in particular, if we start to unpack what the key drivers were, if we look at the right side of this page and we look at low quality stocks versus high quality stocks, and think about that as companies that are more or less profitable, have a stronger, weaker balance sheet, sort of that dichotomy. If you break down the market into those two segments, what we saw was a real strong outperformance, a dramatic outperformance from low quality stocks versus higher quality stocks. So what can we attribute that to? Well, if we look at this subsequent page here, what we show on the left side is the spending on AI from the largest hyperscalers, the mega cap tech companies, several of which populate the Magnificent Seven. So think about Amazon, Google, Meta, those types of companies, where their ramp on AI spending has been really dramatic. And so dramatic, in fact, as we illustrate on the right side of this page, that it's actually had an impact on GDP, a measurable impact, sort of the order of magnitude that they've ramped up the spending. And why have they ramped that spending? Well, if we look at the next page, what we can see is this promise of productivity growth, that AI will be able to transform the economy as we think about displacing labor, perhaps, and using AI agents, using AI in a variety of different ways to get more productivity out of every labor hour that we spend. Now, that ultimately has had an impact on some of these stocks that might be smaller cap, small and mid cap stocks, might not actually be profitable at this point. But investors are so enthusiastic about this impending productivity boom that they're willing to bid up these companies. And that's where you see that dynamic unfold, where lower quality companies have outperformed higher quality companies in this type of environment. It really all ties back in several different ways to the AI theme, generally speaking. Now, I think the risk going forward is that this doesn't materialize. We're starting to see productivity increase somewhat, but if we don't get, we don't really achieve the full manifestation of the promise of AI, if we don't see a true productivity boom unfold, and we don't see the earnings and the revenues accrue to these companies, which people are more speculatively bidding up in markets at this point, that becomes a real risk in our eyes going forward. But certainly has been a key driver of performance, in particular within Q3. Last, we'll spend a second here talking about gold, because it has been a phenomenal performer on a year-to-date basis, up about 47%. And I think you can't talk about gold without talking about the US dollar. So what we show on the right side of this page here is the dollar in trade-weighted terms is down about 10% on a year-to-date basis. One of the worst years that it's had if we go back over the last 40, as we illustrate here. And if you think about the dynamic between those two, it's really, you've got more concern about policy uncertainty and the ability to use trade policy in particular as a bit of a weapon against countries around the world. So perhaps they are migrating away from dollar-based assets because they don't want to be exposed to the U.S. government's ability to either restrict their trade, restrict their access to dollar-based assets, et cetera. So what do they do in that environment? Well, they flip out of their dollar exposure and into other currencies, or in this case, several central banks around the world are now moving into gold, right? So you're seeing that dynamic play itself out, a rotational element there away from US dollar into gold. And I think alongside that, you've got fiscal deficit concerns, you've got inflationary concerns, which gold certainly speaks to as well. But nonetheless, that's really the backdrop that we've seen for gold's outstanding performance on a year-to-date basis. So we'll leave it there for this quarter. Again, my name is Andrew Krei. Thanks for watching.